Navigating this economy has never been more confusing or frustrating, and that really goes double for 2024. Is 2025 going to be any easier? I'm Mike Eppel, and this is In This Economy. And today we're looking back at the year that was. Was anything that happened predicted 12 months ago? Of course, some things were unpredictable, but we do like to review and then try to figure out what's next. Well, joining me to do that today is Doug Porter, the chief economist at the Bank of Montreal, to talk about some of the highlights and lowlights of the year, and then getting out the crystal ball for the new year. Thank you very much for joining us, Doug. Good to talk to you.
Well, thanks for having me, Mike.
Doug, I think we can describe 2024 as a tale of 2 years mixed into one. When we look at what central banks were doing up until about the midpoint of the year, they were aggressively holding at a tightening policy. And then around June and July, the Bank of Canada kind of kicked things off, easing up, saying, okay, it was time to adjust. Was that what you were expecting that they would do over the course of 2024? And subsequent to that, were you as surprised at how aggressive they actually got with the interest rate relief?
I would say yes and yes. So in other words, the Bank of Canada actually pretty much stuck to the script in terms of when they started to cut interest rates. We had been penciling the June meeting, so the timing was about as expected. I will freely admit the Bank of Canada ended up doing a lot more than we and I believe the market expected. And to be clear, they were the most aggressive rate cutter in the world. There were others that came close, but nobody else cut rates by 1.75 percentage points this year. And, full disclosure, we were looking at about a percentage point of cuts at the start of the year. So yes, the Bank of Canada was much more aggressive than we expected. And it's interesting because when you look back at how inflation and growth fared, really wasn't that much of a surprise. If anything, the economy actually did slightly better than expected. But I will say inflation came in a bit lighter, and that's, in hindsight, that's exactly what the Bank of Canada focused on. The fact that inflation actually did moderate down to, less than 2% by the end of the year.
Although they were adjusting what they were focused on. Yes, it was about inflation, but then all of a sudden the narrative changed. They became more concerned about the unemployment rate going up and the economy. We look at the GDP statistics. The critics would say, if you will, that if you take out population growth, it's been negative for quarter upon quarter upon quarter. Now, of course, the Bank of Canada's mandate isn't specific to the economy in as much as they target inflation, but at the same time, it was interesting to see that narrative change.
Indeed, and the strong population growth, which we saw again this year, was a big economic story. And frankly, it's one of the reasons why the job market does look so weak, because it's interesting. Canada is actually still creating a lot of jobs in terms of job growth. Canada is matching the U.S., if not even seeing a little bit stronger growth than the U.S. But at the same time, we've also had just such robust population growth in the last couple of months that the economy just hasn't been able to keep up. And so as a result of that, we have seen the unemployment rate rise roughly by a percentage point in the past year. And that's a pretty big move. Again, that's not that much of a surprise. That's roughly what we were expecting a year ago, was for the labor market to weaken. But clearly the Bank of Canada responded pretty heavily to that. I would add just one more thing and one more reason why I think the Bank of Canada got so aggressive right at the end of the year. I do believe they're worried about the trade outlook with the US over the next year. They hinted around that in their last rate decision of the year, but I do think it played a role in the bank getting or staying super aggressive in terms of rate cuts right at the end of the year.
Yeah, it was as if the central bank here and elsewhere, of course, they really had to get out the pencils and erasers and kind of adjust their thinking when the U.S. election happened and the results rolled in, because I think there was this narrative that the Democrats would maintain the White House, and that certainly wasn't the case at the end of the day. And then, even before we see a new incoming administration, President-elect Donald Trump is talking about these massive tariffs, and it was like this twist to the tail, so to speak, where everybody had to adjust, not just at central banks but at the political level, certainly, that everybody's kind of going, okay, we have to be prepared for what comes next.
Yeah, and the one place where it's obviously really showing up is the currency market. It's been a bit of a mixed bag for equities and yields. You know, the so-called Trump trade is higher on all three. In other words, a stronger U.S. dollar, higher yields, stronger equity markets, and we've mostly seen that. But the one clear theme that we've seen even before the election, when it started to appear that Trump was going to win, is that the U.S. dollar has just been on a rampage against all currencies, and of course the Canadian dollar has been on the other side of that. Some of this is a Canada-specific story, but it's first and foremost a strong U.S. dollar story that's really pushing the Canadian dollar down. We're essentially falling in line with most other major currencies, but I would say that's probably the single biggest market effect we've seen from the re-election of Donald Trump, is that the U.S. dollar has just been on a roll, and that's of course the flip side of that is the Canadian dollar has just been in a tailspin.
Well, I think one of your when we look back on the predictions you had put out a year ago, I think if I'm not wrong, the underestimation, I suppose, about how strong the U.S. economy would be was one of the things. I mean, the Fed has kept interest rates elevated. Yes, inflation is down, but I mean, you're still looking at a very strong GDP growth rate, and the American consumer just will not slow down, will they?
And I would characterize that as probably being one of the biggest surprises of 2024. And in some ways, it's a replay of 2023. You know, for the second year in a row, the U.S. economy grew by almost 3%, which is well above its long run average. Very robust performance. I guess the good news for the U.S. perspective is a lot of that growth has been accompanied by fairly solid productivity growth. Quite a different story than here in Canada. And as a result of that, they've been able to have both strong growth and an improvement in inflation. So it's interesting that even though the US economy surprised to the high side over the past year, the Fed actually ended up doing pretty much what we and a few others had expected at the start of the year, and that was to cut rates by a percentage point, by 100 basis points. Now, of course, as we end the year, there's quite a bit of disappointment or concern that the Fed is going to slow down that amount of easing as we go into 2025, and that is understandable, given how much momentum the U.S. economy retains. And yes, the U.S. consumer is a big part of that. It has remained remarkably healthy throughout this. You know, as we end the year, U.S. auto sales are actually at one of their best levels in years. And while the unemployment rate's up a bit, it's still pretty low at 4.2% in the U.S. And so I think the U.S. consumer is still in relatively good shape. And loaded on top of that, of course, you know, the U.S. equity markets had a tremendous year, even with a little bit of a wobble here late in the year. And so Americans are sitting on a lot of wealth, as well as a relatively healthy underlying economy.
I think it also highlighted the difference in the mortgage market between Canada and the U.S. The fact that Americans can borrow for such much longer terms and not have to worry about the great mortgage reset that we do here. Sure, interest rates have gone up, but there never seemed to be that, oh my gosh, the American consumer is going to have to deal with something in a very short term. It's almost as if it's an afterthought.
Yeah, that's true, and that's really the big difference between Canada and the U.S. in the last couple of years. They're just not nearly as interest sensitive as we are, and there's really three reasons for that. First, as you mentioned, Americans did a wonderful job of locking in their 30-year mortgages when rates reached exceptionally low levels during the pandemic, and they've been able to skate through this. A second factor is their household debt levels are much lower than ours are, and that's a big change from 15 years ago. And the third reason why they're less interest sensitive is the housing sector as a whole just isn't as important an element in the economy as it is in Canada. And of course, the housing sector is the most interest sensitive sector. So for all those reasons, the U.S. economy is just less vulnerable to that backup in rates that we've seen over the last couple of years, and has managed to just plow through this over through 23 and 24.
So, as we look forward to a new year, and a year that is going to kick off with a whole lot of uncertainty, just because the incoming president is threatening, day one to do numerous things that could really upend the economy. Is there a way to actually put in a forecast at this point, or have you said, you know what, this is one of those times when we actually have to wait and see to see how things develop?
So we do have a base case forecast that assumes that Mr. Trump dials back on his tariff threat on Canada. But of course, we have to be armed with a forecast of, well, what if? What if he actually does impose a 25% tariff? And of course, those are very different worlds in terms of what it means for interest rates, for the Canadian dollar, and for growth. But our base case is actually fairly decent growth in Canada. I just mentioned how we're one of the most interest sensitive economies in the world. Well, that cuts both ways. Of course, when interest rates are falling, and they have been plunging in Canada, that goes from being a big drag on the Canadian economy to being a big help. And so, a great weight is being lifted off the Canadian consumer and the housing market. And we think the domestic economy will do just fine over the next couple of years with interest rates having fallen as much. And we do expect some further, at least moderate interest rate cuts from the Bank of Canada next year. So we think that actually sets the domestic part of the economy up relatively well. Of course, the major wild card is, do we get hit with tariffs? If we do, then I don't think economic policy is going to stand still. We're likely to see the Bank of Canada respond with even more aggressive interest rate cuts. We're likely to see fiscal policy respond. I suspect that this year's budget, both federally and at the provincial level, would do whatever it could do to support the economy. I think we'll see a lot more spending, even more than they would have normally done at the federal level, and yes, at the provincial level, if we are hit with those tariffs. And unfortunately, the Canadian dollar would likely weaken a lot more so than it already has if we are hit with 25% U.S. tariffs. And with all of that support, that would help the economy somewhat, but we'd still be looking at much weaker growth in Canada. It is very serious business for the Canadian economy if we're hit with a 25% tariff. They're different estimates, but economists that I respect who've taken a long look at this suggest that if everything stayed the same, it would reduce Canadian GDP by 2 to 3% if we were hit by 25% tariffs. Now, all those other policy changes that I suggested would somewhat offset that, but I think we'd be looking at growth of between 0 and 1% next year, even with a lot of help from fiscal and monetary policy, if we are hit with 25% tariffs.
Now, you mentioned government spending, though, on that. That assumes that we actually have political stability, and right now it doesn't. At the federal level, we just had the fiscal update, which showed further deficit spending, and some criticism going out from the former finance minister related to that, who specifically said they got to be prepared for the need for government intervention if tariffs occur. So under that circumstance, how much does the unknown about what's happening in Ottawa and the federal opportunity or wherewithal to intervene and boost the economy, how much of that is, I guess, unknown at this point, but also a concern?
So it's a complication to be sure, but we've known all along we were going to have an election in 2025, and I think all of us can see the polls and surmise that there's a good chance we've got a change in leadership at some point in 2025. But I suspect that the response, while the structure of it might look a little bit different, wouldn't really matter who's in charge in Ottawa, because I think if we're faced with the heavy weight of U.S. tariffs, fiscal policy is going to have to lean in a certain direction in any event. It will have to respond. Whether it's tax cuts or spending increases, fiscal policy would have to be supportive of the economy. In other words, loose or supportive of growth. And yes, that means higher deficits. And I don't think it matters who's in charge. Even if you hate deficits, you really have an issue with what's happened in the last couple of years. The reality is when you're faced with a very tough economic circumstance, there's really only one right answer. Because the main message is Canada's, well, it's been a bit disappointing on the fiscal side in the last couple of years. Overall, our fiscal position is relatively healthy compared to most other economies, and that's why you have a healthy fiscal position, so you can respond to really tough circumstances that befall the economy. And I would regard a 25% tariff from the U.S. as being a very serious situation that I think fiscal policy would be well within its right of responding to with, like I said, either tax cuts or spending increases.
It almost sounds as like we have to get through the first few months of the new year to see how the dust settles, doesn't it? And that's on numerous levels. How the new administration takes over in Washington, and we're going to have an election one way or another next year. But how that actually shapes up for the current government still remains to be seen.
Yeah, and to respond to the first part of the question, yeah, we are, we've got a forecast for next year, an assumption. Definitely, we're waiting to see what happens on January 2021, and it's interesting. Both the Bank of Canada and the Federal Reserve meet the very next week. And by the way, just as a small trivial aside, the Bank of Canada, 5 of their 8 meetings next year are on the same day as the Federal Reserve meetings, which is extremely unusual, where the bank decisions will be made on the very same day as the Fed. Most of the decisions next year, in the January meeting is one of those 5, where they're both deciding on rates on January the 29th. That's going to be a tough decision, because both are going to have to respond very quickly to what they see from the new U.S. administration, and just within the first week of that administration. If we are faced with tariffs right off the bat, late in January, then I think the Bank of Canada is going to respond with possibly another heavy duty interest rate cut at that January 29th meeting. But I'm sure, just like us, the bank and the Fed are waiting to see what unfolds in those first few days of the next Trump administration.
Let's wrap up with the fearless forecast rapid fire, if you will. Let's start with, okay, you mentioned earlier the Canadian dollar. Is it higher or lower than where it is right now? It's just barely above 69 cents.
I would say the short answer is it's got a lot of downward momentum. I think there's probably going to be a bit more near-term weakness, and that's especially the case if we do get hit with 25% tariffs. I would hazard to guess the currency is going to be stronger a year from now. Though there is a lot of bad news built into the Canadian dollar. There's a lot of good news built into the U.S., and I think some of that will reverse over the next 12 months.
Do you see the Bank of Canada getting down to the so-called neutral rate of 2.5 or 2.25% in 2025?
Yes, we do. So even our base case forecast, and this is without tariffs, has the Bank of Canada trimming further to 2.5%. If we get hit with tariffs, we're going into the ones, I believe. And it's unfortunate, but that's what we would have to lean on if we're dealing with a really hostile trade environment. We would have to lean on what we can support, and that's the domestic side of the economy. It's really not the best outcome for the economy longer term, but yeah, we'd be leaning on the consumer and housing, and that means lower interest rates.
Real estate market rebound in 2025?
I think so. We've already seen it in the last couple months. It took a little bit of time for the market to begin to stir amid Bank of Canada cuts, but clearly in October and November it was getting back on its feet. Sales were back a little bit above their long run average. Prices are responding remarkably quickly to what sales are doing these days. So we look for a pretty solid gain in sales next year and a moderate increase in prices. The one reason why I don't think it's going to be quite the response that we would have normally seen, say, 5 or 10 years ago, is we're starting off at a level where affordability is terrible. So it's not as if we're going to have a lot of people rushing into the market, but there is some pent up demand. The other reason why I don't think the market really roars back is the population growth backdrop has just changed remarkably so. We are not going to have that population growth support for the next couple of years. So that takes a little bit of an edge off of the market. But I do think with a much more mild interest rate environment, yeah, that does set the stage for a rebound in the real estate market.
Price for oil for the drivers among us who haven't shifted yet to electric vehicles. Price for oil up or down at the end of the year?
So our official call is for it to be mildly stronger, not a lot. And I will say that actually is one thing that was a bit of a surprise this year, is how weak oil was, and some of it just relates back to the underlying softness that we saw in the Chinese economy. It's not because OPEC didn't try; they have really been pretty disciplined in containing production. But meanwhile, quietly, U.S. production has just kept chugging along. I mean, I always kind of am amused at this, drill baby drill that Trump has talked about and Republicans are leaning for. Little factoid: There was more oil produced in the 4 years under Biden than there were under the 4 year Trump's first term. We've actually had record U.S. oil production under Biden. That's one of the reasons why oil prices remained a bit soft. Looking ahead, we believe that we're not going to see quite the same growth in U.S. oil production, and we do believe OPEC will remain relatively disciplined. So we've got oil prices slightly stronger by the end of next year.
We've talked a lot about what we expect for 2025. Is there one thing that maybe nobody's thinking about next year that you see on the horizon, or doing your best prognostication on that might come out of the blue?
Well, I'm not saying nobody's calling for it, but there certainly is the risk that inflation sparks back up again. I have actually been asked, and especially in the wake of what the Fed has done recently, is there a possibility that the Fed could actually raise interest rates in 2025? And that's not crazy talk. That's not completely impossible, because we have seen in a few economies that it looks like core inflation is stuck and is not going much lower. So there is this outside risk that inflation could flare up again in 2025, especially with the U.S. economy still as strong as it's been, and also with that wealth effect supporting consumer spending, not just in the U.S. but in many other economies in 2025.
We'll leave it there. We'll see. We'll come back to you in a year and see how things worked out.
Sounds like a plan.
And again, our thanks go out to Doug Porter, the chief economist at the Bank of Montreal. And that wraps up this episode of In This Economy. If you have an idea about a show or a personal finance question, you can get in touch anytime by emailing us at hello@itepod.ca. The phone number 416-935-5935. Or directly to mike.eppel@rci.rogers.com. Thanks for listening. I'm Mike Eppel.